Hello and welcome to the Business Standard Banking Show. After incurring loss for 13 consecutive quarters, IDBI Bank returned to profitability in the fourth quarter of 2019-20. Since then, there was no turning back. Along with profitability, the bank has improved asset quality, and now the provision coverage ratio stands at more than 90%. To speak to the person behind the turnaround, we today have Rakesh Sharma, MD and CEO, IDBI Bank. Mr. Sharma, welcome to the show.
Thank you very much. Thank you. Thanks for the introduction.
IDBI Bank is now firmly on a profit path. What is the near-term growth strategy for the bank, say in the next 3 years?
Now the growth strategy, if we discuss, first in terms of business, of course, as you know, earlier the bank was under PCA and there were many restrictions were there. But now we have planned 10 to 12% growth, both in retail, MSME and large credit also. But our focus will be mainly in mid-corporate, where the good quality of advances will be available. But we are now growing in all the fields, because as you know, our retail to credit, that corporate credit percentage is 63 to 37%. So more or less, we will like to maintain that. As far as profitability is concerned, you will see upward uprise in the profit, by operating profit also and net profit also, because most of our NPAs have already been provided for. And as you have rightly said, that our provision coverage ratio is 97%. Slippages are also under control. So in all respects, we are expecting good growth in the coming years.
While the profitability has improved and asset quality has improved, the stock of gross NPA is still high, which is around 20%. What is the plan and strategy to reduce that stock?
Once upon a time, about 3 years back, the gross NPA was 31%. So by making accelerated provisions and by making recoveries, we have been able to bring down the gross NPAs below 20%, and net NPA is standing at around 1.25%. Gross NPA, as you see, the major part of our NPAs are already 100% provided. If we do write-off, technical write-off for those 100% provided accounts, my gross NPA can be less than 2%. But because of some tax implications, we are not doing that. But of course, I agree that we have to reduce our gross NPAs. So the major strategies will be, one, of course, is recoveries through NCLT, negotiated settlement route, and OTS route also. And partly, of course, we are also thinking of transferring some of the assets to NARCL, which of course we were expecting somewhere in the June quarter, but slightly it was delayed. But in the, I think Q3 and Q4, we will be able to transfer some accounts to NARCL. We have identified accounts worth 11,000 crore. So out of that, around 4,000 is already technically written off. So remaining 7,000 crore will be transferred to NARCL. So this will help us in reducing the gross NPAs below 15%, and that is my target, to reduce the gross NPA below 15% by 31st March 23.
Sir, IDBI Bank in recent past has shown very aggressive strategy on recovery. Recovery figures are also very healthy. Can you throw some light? What is the recovery strategy going ahead?
Yes, one thing I would like to clarify that, during this COVID period, some recoveries through NCLT had slowed down, but we continued making our recoveries in by way of negotiated settlements and one-time settlements, and also the small accounts by launching some non-discretionary schemes for one-time settlement. So this year we have targeted recovery of around 4,000 crore, and Q1 my recovery was 1,100. So we have already achieved 25% of that target. So I'm quite hopeful that this year we will be able to recover more than 4,000 crore.
Sir, coming to slippages now, your slippages in the first quarter was about 964 crore, lower than the Q1 of same period last year, which was around 1,300 crore. Do you expect slippages to further come down in the coming quarters?
Yeah, I fully agree. In fact, in Q1, some two corporate accounts had also slipped. In fact, the breakup of this 964 crore was corporate 443 crore and retail 521 crores. So in this retail, in fact, retail slippages have also come down proportionately as compared to previous year. And in the coming quarters, because our recovery percentage is quite good, and the collection ratio is more than 96.5%. And we have been able to stabilize both our collection and recovery vertical very efficiently. So I expect that even as compared to 964 crore, during the remaining 3 quarters, it should further come down. In any case, my slippage ratio for this current financial year, I have kept it at 2.5%, but I am sure that it will be much below 2.4%.
And sir, your guidance on credit cost, what is your guidance on credit cost? It was 0.52% in the Q1 of FY23.
Yeah, in fact, if you see the regular credit cost, if we do not do the accelerated provisioning, then certainly it will be in this range only, 0.5 to 0.75. But I am targeting the credit cost below 1%. Earlier, we had estimated it to be 1.25%, but now since we have been able to control the slippages, and in any case, there are no major aging provisions. So this credit cost, in any case, maximum, it will be 1%, but I am expecting somewhere between 0.75 to 1%.
Now coming to upgradation, sir. Upgradation in the first quarter was lower than any of the quarters of the last financial year. What could be the reason for that? Is there a matter of concern that going ahead, the pace of upgradation could slow down?
Yes, I agree that in Q1, there was no big account was not upgraded. But in the coming quarters, we are expecting 1 or 2, not in Q2, but I think by 3rd quarter or 4th quarter, 1 big account we are likely to upgrade. But overall, what I am estimating is that the overall upgradation plus recovery will be much, much better than the slippages part. Is this? So either by way of recovery, we will be able to recover NPAs, or by just upgradation. But some accounts, of course, we are like, especially those which were restructured earlier. So these we are expecting to that there will be upgradations in the coming quarters.
Coming to the business side, sir, the deposits, first of all, is the deposits. Now, we have seen your total deposit has fallen in the first quarter on a sequential basis. There was a fall in the savings account, the current account, the retail deposits, as well as the bulk deposits in the June quarter as compared to the March. Now, credit growth has started picking up, and most of the banks are deposit growths are lagging credit growth. How do you ensure that you will you will ensure deposit growth to match the credit growth?
You see, traditionally in banking circles, the Q1 normally there is a decline in growth, because what happens is that most of these government deposits, these are released as on 31st March. So sometimes willingly or unwillingly, there is some inflated deposits are there. And generally, most of the banks have shown decline in deposits in Q1. But despite that, our, the CASA percentage was 55.65%. This thing, and YOY also there was a growth. So what I feel is this was, of course, one off, because generally in Q1 there is a decline. But in the coming quarters, of course, now there is, because of increasing interest rate scenario, also we have also increased the interest rates. So our term deposits and saving bank deposits have started showing good increase. Or as far as this credit growth is concerned, earlier we were sitting on a good liquidity position. In fact, our liquidity position used to be more than 140%. So liquidity has never been a problem for IDBI Bank. Now, as I was telling, that we are expecting growth of around 10 to 12%. So this growth, because of the existing liquidity as well as expected increase in deposits, we will be able to match this scenario. And rather, our earlier CD ratio used to be quite low, which was also affecting the profitability. By showing much better growth in advances, even if there is not so much increase, if deposits increase by 10% and advances increase by 12%, my CD ratio will improve. So which will help us in improving the profitability also. So that's a positive sign. But in any case, we are expecting more than 10% growth in deposits.
I know IDBI Bank deposit rates are probably the best in the industry, slightly other than other large public sector banks also at 6.20%. Do you see deposit rates going up further?
One thing I will like to say that we are not the highest, because whenever we are making the changes in the interest rates, we always compare with the peer banks. So we are somewhere in the middle, neither lowest nor the highest ratio. But of course, we try to give the, the competitive, offer the competitive rates to our depositors. Because I will like to acknowledge here that when we were in trouble, especially during our PCA period and when the bank was showing losses, it is the customers who always stayed with us. They never, there was never any reduction in deposits. Whatever reduction in deposit had taken place, that was in bulk deposits. So we have to take care of the depositors. So that way we are offering quite competitive rates, but not the highest. But yes, our rates are quite good to attract some deposits. As far as the interest rate scenario is concerned, yes, like, as you see that international markets also, Fed, they are also expecting to increase rates. Then inflation is also around more than 6%. So likelihood that if RBI increases the repo rate, so we'll have to also go by the market. And there may be slight increase in the interest rates, keeping in the view the overall market scenario.
Coming back to now the credit side, most of the banks have seen improvement in credit demand from corporate credit demand. I'm sure IDBI Bank has also seen that. But I mean, what kind of overall trade growth you said you see at 10 to 12%? But this growth will mostly come from retail or corporate?
Both. As I said, like now we are growing in all the areas. MSME, retail, large corporate, mid corporate. And of late, we have started seeing some growth in deposit demand in advances also. Main reason, of course, one is, of course, the utilization is increasing because the capacity utilization is increasing in the industry. COVID situation has already gone and the things are moving up. And now some investments have also started happening. And then, of course, because of the rising interest rate scenario, some bond market also a little bit slow. Earlier, the bond market was quite buoyant. So now some funds are being diverted towards the credit offtake also. So all these factors have contributed to this, and we are looking, towards the increased demand in credit. So that's why, like, although I am targeting 10 to 12%, it can be more than that also, depending on the demand. But of course, one thing is clear: we will be going for the quality assets.
But your retail, as you said, your retail is 63% of the total loan book. Do you want to maintain that kind of ratio, or you think some correction will take place and retail share may slightly come down now that the corporate demand is coming back in a big way?
Yeah, in fact, slightly it may be, the corporate ratio may increase also. But as per our board approved policy, minimum that retail portion, what we have stipulated, that it will not go below 60%. So now it is 63. But as of now, I am targeting almost equal growth in all the verticals. So that way this ratio may continue as it is. But even if the demand from corporate is more, and we, and good assets are available, and we decide to grow more in corporate credit, so the ratio, we will not go below 60% for retail.
Because that's a board-approved policy to have retail at 60%.
As of now, our board-approved policy is that minimum retail ratio should be 60%.
To fund this credit growth, a lot of banks are going to the market and raising capital. Many of the banks in the last few months have gone and raised 81 bonds. Do we have any plans to raise capital, maybe via bonds or equity?
No, as of now, if you see, my CET and Tier 1 ratio is 17%. And total capital adequacy is 19.57%. Yes. So the capital wise, we are quite comfortable. And bonds also, you see, the deposits and bonds is and the internal funds are also being generated. This like Q1 profit is not added in this capital adequacy ratio. The capital wise, we are quite comfortable. So as of now, although we have taken board approval to raise certain bonds, but immediately we do not have any plan to go for either this QIP or some bond raising. But times to come next year onwards, or whenever we need, we feel that there is growth. So that time we can go for it. But presently, I think we are quite adequately capitalized.
And sir, finally, the government and the LIC is planning to sell stake in IDBI Bank. When do you think the process will start in terms of inviting bids from prospective investors?
Actually, I will not be able to give you the exact timeline because that is the prerogative of DIPAM, because the entire process is being held by being managed by DIPAM, the government of India. But of course, like, yes, DIPAM has, the government of India has announced that they want to, disinvest IDBI Bank, and the process is going on. But exact timeline, my request to you will be that I think DIPAM will be the appropriate department to give reply to this question. But whatever happens, we are ready for this. And as I always say, and I have been telling that my focus is to improve the profitability and improve the efficiency ratios in the bank, so that when number one, the stakeholders get good compensation for this, and whosoever new promoter is coming, they should get a good bank to hold. So that will be my focus. Of course, the entire other thing is left to the owners, DIPAM and LIC, when they want to come and how much they will like to dispose of.
It was a pleasure talking to you, Mr. Sharma. Thank you very much for speaking to Business Standard.
Thank you. Thank you very much. My pleasure too. Thank you very much.
Thank you, sir.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.